Welcome to DrJLT Economics. I'm Dr. DrJLT. In today's episode, I want to talk about the forbearance and moratorium programs introduced in the United States and what are their implications now for the economy, for not just inside the United States, but also abroad, internationally, and what could be the exit strategy for the US government and how that could impact the world economy. I want to say first that I actually recorded another episode yesterday on this topic, but I talked also about the European Union. But then I realized that there were simply too many aspects that have been mentioned in that video and that in that recording, and it just simply became too long and a bit untractable. So I decided to re-record this episode and focus uniquely on the US situation, the American situation. Anyway, so first things first, let's talk a little bit about what they have been doing. Unlike other countries, the United States have witnessed the Americans have witnessed a combination of some of the toughest lockdowns in select states and some of the weakest government support for income for wage earners, basically. So a lot of people who have who had been living decently are now have found themselves basically in deep financial troubles. This partly, of course, I would first preface this by saying that I personally think that these individuals are partially to blame because they have, in essence, been living beyond their means. But on the other hand, I think their share of the blame should be quite small because they have been led by the system to basically live beyond their means. They have been encouraged by the system to live beyond their means, because when everyone is taking advantage of cheap credits, it is those who live beneath their means simply find themselves leading a lower standard of having a lower standard of living, while at the same time not at the end being ahead financially. So of course they decided that probably they would also borrow, and that's why everyone have found themselves in such situation. And what the US government have done instead is to issue all these mortgage payment forbearance programs, to extend those student debt forbearance programs, rent moratoriums, and etc. All these things combined basically make the immediate sufferings much less perceptible. Now, what are some other consequences of these programs? I think this is quite obvious if you look at the hundreds of new billionaires freshly minted in 2020, and if you look at the stock market, if you look at guys like Jeff Bezos, Elon Musk, you will see very clearly what are the other consequences of these programs. Because people who have long been living beyond their means, who are now allowed not to pay their mortgages and not to pay their student debt and not to pay their rents, what happens is that a lot of these people are beginning to spend more money on consumption. And so as a result, we see online purchases have posted, of course, record numbers. And of course, the biggest beneficiary of this is Amazon. It is no surprise that Jeff Bezos is the richest man in the world, right? I think statistics show that in the United States, over 50% of online purchases are made on Amazon. And this is based on a number that is larger than ever before, particularly since all the small and medium shops have been forced to close. So of course, this creates all these consumptions on those big platforms, and so that is the short-term effect. And of course, this cannot go on, I think, forever without some sort of reckoning. There has to be some sort of exit strategy, or at least an end game. Let's call it an end game, not necessarily a strategy, because it could end in one of two exit strategies, but I think it can also be an end game without a strategy. So it's some sort of disorderly ending of these programs. So I want to basically run them down, and I want to talk about what are the mid to long-term implications of these. The first of the exit strategies will be to follow the Obama playbook of 2009, basically 2009. And what that was, if you are unfamiliar with it, is that Barack Obama, led by the big banks and some and select financial institutions, elected to, number one, got a lot of money from the Federal Reserve, which were just printed. They gave these money to select financial institutions. These and then the banks would foreclose on the homeowners. There are a lot of forced foreclosures, and of course, this includes not only homeowners who are living in those homes, but also landlords who have been engaged in these buy-to-rent schemes or plans, right? So the banks foreclosed on them, and then the banks sold these assets, basically these houses, to the select financial institutions that have received money from Barack Obama. And so this was the playbook of 2009, and a lot of people have been talking about the possibility of the Biden-Harris administration doing something that is quite similar, and I do see this being one of the most likely outcomes, right? Foreclosure, money printing, and privatization of assets. That's, I think, the most likely one. The second possible exit strategy has also been talked about, which may indeed be applied to student debt, but less likely, I think, with assets, which is some sort of forgiveness programs, like, for example, rent forgiveness or mortgage payment forgiveness, or student debt forgiveness. So up to a certain amount, the government would just simply get money freshly printed from the Federal Reserve and then the government would then immediately transfer the funds to the banks that have underwritten those debts, right? So the banks wouldn't have to lose anything, and in this scenario, nobody has to lose anything. Everyone is going to be quite happy, except of course the select financial institutions, which might have been salivating all over the last 12 or 14 months, waiting for a replay of 2009, 2010. So that is a second possible exit strategy. Of course, Then there is this disorderly scenario that I also mentioned, which would be that the government assesses their two options. One is perhaps quite unpopular and would be bad for the re-election of, let's say, for example, Kamala Harris in 2024. It will be very difficult for her to, I think, get re-elected if they do this type of 2009-2010 playbook, particularly in the next year, basically quite close to the election, when the primary is already starting to take place. They do that. It will be very difficult for them to get re-elected, so they may not want to do that. And then there is the problem of on the other hand, there is a lot of I think they should realize, I believe they should realize that there is strong moral hazard at play with the second scenario. Basically, I'm not entirely certain that they do realize, but there is a strong argument against all these forgiveness programs. And I will explain about a little bit more next. So, but now let me just talk about the disorderly scenario. The disorderly scenario is that when the Biden-Harris administration realizes that their two possible exit strategies are both so toxic, what they may elect to do is to extend these forbearance and moratoriums, all these economic programs ad infinitum. So what that means is that they try to keep on printing money, and perhaps most likely at an accelerated pace, especially since we have already seen that Joe Biden has broken the record already within the first 2 months of his administration. Or maybe Biden-Harris, their administration, they have already printed $2 trillion, and they are already unveiled a plan to print another $2 to $3 trillion before the summer. So I think perhaps they will keep on printing money. So perhaps in 2021 we will see about $8 to $10 trillion, and in 2022 it will be even more. I would say 10 to 15 trillion, and then perhaps continue to expand that pace. You are seeing that already. The Federal Reserve has stopped talking about how much money the M1, M2, all these statistics. They tried not to reveal those data. They instead elect to say that inflation is not related to money supply, which of course is modern monetary theory. I have never heard of this before. That monetary supply that has no impact on inflation, but of course it is a it's highly politicized. Central banks are highly politicized, so it's probably more correct to say that it is modern political monetary theory. Perhaps that is what it is. Basically, they will say whatever that is politically convenient. Anyway, so they will continue to print money and they will extend all these programs. But I think then we will simply see a disorderly end to all these programs, because in the short term, these programs keep things afloat. In the long term, it actually does the exact opposite of what they want to do, which is pump up all the money, all the bubbles. This will be the pin that popes the bubble, right? That picks the bubble. Why is that? Because when we talk about real estate bubbles, which very likely is one of the first things to pop, real estate bubbles depends on the ability for the real estate to generate incomes. Of course, when you guarantee all these loans and you make sure that people don't have to pay to pay their mortgages, real estate prices in the short and medium term really goes up. It keeps climbing. It will continue to climb because people who are able to comfortably borrow, let's say $1 million, and perhaps quite uncomfortably will be able to borrow $1.5 million. We like to borrow the larger of the two numbers. They would like to borrow more because they know for sure that if the prices come down, if their equity is less than the mortgage, right? That the remaining sum that they have to pay, the government they will not have to pay anymore. The government will come in, and the government will forgive their mortgage. So in this scenario, people will just go in and beat up the price. So in the short term, the prices will come up, will continue to rise until a point is reached where people who are making purchases, purchasing houses to rent to other people, find it impossible, quite unprofitable, because those people are not paying their rent either. So they are not paying their mortgages, but people are not paying their rents. So when that happens, they will probably start to think, okay, I have this house, my mortgage is forgiven, but since I cannot generate income by renting this house out, let me sell it. And so then people start to sell, and this will basically be the start of this will be the beginning of the end. And this, I think, it's a form of a disorderly unraveling of all these programs. And of course, it could be preceded by an even sharper drop in the value of the dollar, which I think assessing by the speed at which I think the Biden-Harris administration will be printing money, it will be quite surprising if the US dollar doesn't drop precipitously. And I'm talking about like 50% in its purchasing power within, let's say, this administration. So that is the three scenarios. And of course, I don't want to talk too much about the disorderly scenario, because that will be a stagflation scenario, which I think I've already discussed in previous episodes. So I encourage you to check out the playlist and the name, I think, US dollar. I want to talk just slightly more about the other two scenarios, basically the two exit strategies. The first one, if I just to remind you a bit, is the possibility that they implement again Barack Obama's 2009 playbook. In this scenario, I think, of course, the real estate bubble is going to be capped, will be reinflated, but at the same time, I do see a spreading of the contagion, in the sense that all these private investors, all these financial institutions who have already amassed large quantities of rental real estate are now going to load up on even more rental real estate. And these financial institutions are deeply connected to other types of bets based on the underlying assets. So that what I mean here is that they have issued all these they have sold all these financial instruments, complex bets, the derivatives, all these things that are held by other financial institutions and sometimes even pension funds. And this will basically spread the risk of the bubble, of the real estate bubble. And so on the one hand, we will see a worsening of the wealth gap. Basically, the rich will get richer, the poor will get poorer, while at the same time, if the price of if housing price just simply drops a little bit, or people stop paying their rents, a lot of people lose their job and stop paying their rents, and there is no rent moratoriums, then we will see a big unraveling, cascading effect. This is the systemic risk. And secondly, on the printing money and the debt forgiveness side of the exit strategies, I think perhaps this is even worse. In my judgment, it could be worse, because this introduces a huge moral hazard, and this is quite textbook moral hazard. You will see, for example, people who will buy more expensive houses or beat up the housing prices, right? And when this happens, I think again this will be worse. There will be a worsening wealth gap. The rich will get richer, the poor will get poorer, and all at the same time, I think all these people are exposing themselves personally to the systemic risk. When the housing market just simply drops a little bit, they will be in bigger trouble. Now, of course, they will expect that the next government will come in and they will forgive their mortgages, but the moral hazard play is such that indeed it is not entirely certain. It is not entirely certain. Let's say the government next time again forgives their rent. What's going to happen? Well, this will be an even further escalation of this situation. People will continue to beat up the prices, and eventually we will see even some of the shittiest houses will sell for some of the most astounding prices, and nobody will be able to buy it normally, and everyone who wants to make purchase of these houses will have to lever up, will have to expose themselves to these programs, and so this I can hardly see this being going on forever. This will eventually lead to the disorderly scenario, right? And when it comes to the student debt and other forms of debt forgiveness, then I think similar moral hazards will be at play. Students who have, parents who have saved up to pay for their children's tuitions would elect not to pay out of pocket, but instead would ask their children to borrow money from the banks to make basically student loans. And the reason is to take out these loans because they expect that the government will forgive these loans. And so what happens then is that they will be less selective in terms of which university they attend, and the universities will then be able to increase their tuitions, and their board of trustees will be able to pocket more, more bonuses for themselves, and then the students will have to take out more loans, and this will continue, of course, until it becomes very clear, or perhaps when the government stops these programs, or when the government says, okay, there's a ceiling, and eventually, basically, there will be a disorderly end where the tuition will be so high that nobody wants to go to school, and so the school has to dramatically slash their tuitions, and everyone will basically go back to earth. And so I think in sum, I think all these programs have a similar effect, and in terms of how this happens, it's all intervention, unduly intervention by the government, because they have had some prior misguided policies. So now they want to use more bad policies to correct their former bad policies. And what this creates is moral hazard. What this necessitates is money printing. And what this will lead to is, I think, some disorderly end to all these formerly mentioned bad policies. And perhaps also alongside a precipitous drop in the value of the dollar and the prestige of the American economy. All right, so that is this episode. I think in the next week, I want to talk about perhaps the European Union. I want to particularly talk about the Euro crisis, which I see really brewing already in the last decade, and I think is going to enter a new stage in the next couple of years. So if you are interested in listening to that, I encourage you to subscribe to this podcast. Thanks for listening, and have a great day.